Hi, this is Lara at Elliott Wave Stock Market with an extra video update for you for the S&P 500 after New York closed for the session dated 3rd of May. It looks like we've got a small bull flag pattern completing. Volume during this pattern suggests the breakout's more likely to be upward. The measured raw target gives a target about 2459. The Elliott wave analysis gives a target about 2469. Support about 2380 has been holding for the last few days. If the last gap is closed, though, then it technically won't correctly be a measuring gap, it will be an exhaustion gap. If that happens with a new low below 2376, expect price then is likely to move substantially lower to make at least a slight new low below 2328.95. Elliott wave analysis first, classic analysis last. Classic analysis has a fair amount of support for this main wave count, which is why it's the main wave count, and not much for the alternate. The bigger picture sees the Elliott wave count in a final fifth wave at 2 degrees to end a grand supercycle upward wave about 2,500, perhaps in a few months. Cycle wave 5 begins here and it is unfolding as an impulse. I can't fit this structure into an ending diagonal. Those are the only two structures that fifth waves can take. So far we have an impulse for primary 1, a regular flat for primary 2, an impulse for primary 3 is a stretched out extension. That's the most common situation for this market. So far we have intermediate 1, intermediate 2 is a double zigzag, intermediate 3 an impulse, intermediate 4 is either over as a regular contracting triangle or it's going to move further sideways as an incomplete combination. That's my alternate idea. It can't move into wave 1 price territory below 2193.91. The final target remains the same. It's been the same for months and months now. Pretty much right at 2,500, cycle wave 5 will reach almost exactly equal in length with cycle wave 1. That's the most common Fibonacci ratio for a fifth wave to exhibit, and so that target should have a good probability. It also happens to be a very nice round number pivot. When we get up there, we should expect to find a fair amount of resistance. Let's have a look at the first wave count, which sees intermediate wave 4 a triangle and complete, where intermediate 3 has its end here. Here's the triangle A, B, C, D, E. The only problem I have with this triangle is E comes to a very brief end and falls well short of the AC trend line. It is most common to see E waves of contracting triangles fall short of the AC trend line, but not usually by that much. And triangles usually are more time-consuming structures. They don't usually come to such a swift end. Now that is the main reason really why I have an alternate Elliott wave count, but that alternate doesn't have a lot of support from classic technical analysis. So even though the triangle end looks a little bit odd, this is still my main wave count. It has quite a lot of support from classic analysis. We'll get to that next. If the triangle's over here, then the final fifth wave is underway for intermediate 5. We've got a first wave probably complete for minor wave 1, and a second wave may very well be complete today for minor wave 2. And here's the little bull flag pattern. If minor 2 does continue further, it can't move beyond the start of 1 below 2344.51. Within this impulse for primary wave 3, intermediate wave 3 does exhibit a Fibonacci ratio to intermediate wave 1. It's 9.86 points less than 1.618 the length of intermediate wave 1. That makes it just a little bit less likely actually that the fifth wave will exhibit a ratio to either 3 or 1, because it's really common for the S&P to exhibit Fibonacci ratios between 2 of its 3 actionary waves within its impulses, and less common for it to exhibit Fibonacci ratios between all 3 actionary waves. So within intermediate 5, when we've got 1, 2 and 3 and 4 complete at minor degree, I'll then use the Fibonacci ratios between minor 1 and 3 and 5 to calculate another target for intermediate 5. So toward its end, this target is probably going to change. Let's have a look at the hourly chart for this idea, where the end of the triangle, minor wave E, may have been this point down here. Here's another problem at the hourly chart level. In order to see the triangle over here, we have to see minor D over here and minor E over here, which means that within minor D, it's a zigzag. We've got a rear running flat for this minute wave B. This rarity of the running flat does slightly reduce the probability of this wave count. It is possible, though, we did have a strong upward movement after the triangle ended with a strong breakaway gap here, and so that upward pull may have forced this B wave to have a slightly truncated minuet wave C and given it the form of a running flat. However, any time I have a running flat within an Elliott wave count, I always consider that to reduce the probability of the wave count slightly. This is a breakaway gap, and so far this looks like a measuring gap. Breakaway gaps and measuring gaps aren't usually closed, at least not for the short or mid-term. So far this measuring gap is offering support. So far it's not closed, and it's been tested now 1, 2, 3 times, and so far it's holding, so that offers a bit of support to this wave count. I've relabeled minor wave 2 today. It looks now like it may have unfolded as a double combination. We've got a zigzag for the first structure in the double, subdividing 535. The double is joined by a brief zigzag in the opposite direction, labelled X. And here we may have the second corrective structure, 335, a flat correction for minute wave Y. B waves within flats can take any corrective structure. At their terminal end, or the end of the E wave of them, if it's a triangle, they have to affect a 0.9 retracement of the previous A wave. If this minuet wave B is complete and labelled correctly over here, then at its end, at its terminus, it has affected the minimum 0.9 length of minuet wave A. It's actually a little bit longer, well, 1.02 the length of minuet A. That means that this structure here would be a regular flat correction, subdividing 335. We classify triangles as threes. So it looks a little bit odd, but this meets all Elliott wave rules and it fits the usual behaviour of a regular flat correction. The C wave ends a little bit beyond the end of the A wave, but not by a great substantial amount, so the whole thing is mostly a sideways movement with a little bit of a downward slope. The target for the Elliott wave count is for intermediate wave 5 to reach 0.618, the length of intermediate 1. I've chosen that Fibonacci ratio because it fits so nicely with the higher target for cycle 5 at the daily chart level at 2,500. For this wave count, if minor 2 does continue further, technically it can't move beyond the start of 1, below 2344.51. If this measuring gap is closed, then minor 2 would have a target about the 0.618 Fibonacci ratio. But so far it looks like it's a fairly shallow correction, falling short of the 0.382 Fibonacci ratio. And the first second wave correction within the S&P's new trends is actually often, surprisingly, shallow, usually briefer than this, but often they are actually quite shallow, even though it's a second wave correction. So I have no problem with the shallow correction here. It does fit recent typical behaviour for this market. In order to see an example of what I mean and why I've made that conclusion, have a look back at November 2016. After a big consolidation, the S&P then continued on upward in early November, and the first couple of corrections along the way up were remarkably brief. So that seems to be typical current behaviour for this market. Let's have a look at an alternate. The correct way to do Elliott wave analysis is always to consider alternates and then rank them according to probability based on, well, I prefer to rank them on Elliott wave structures and classic technical analysis with a heavy reliance on volume analysis. And this alternate wave count still has the final target at 2,500. It's all the same to this point here, and now we're looking at what if intermediate wave 4 was not a triangle, it came to a brief end here. What if it's continuing further sideways as a double combination? Triangles are really tricky structures. If you think a triangle, an Elliott wave triangle that is, if you think one of them is unfolding, it's really important to always consider alternates. They can be invalidated even after you think they're over, and the structure can turn out to be something else. Usually it can morph into a combination. These are really common structures. The first structure in this double combination subdivides 535. This may be a zigzag. The first structure in a double combination is labelled wave W. The double is joined by a 3 in the opposite direction, labelled X. and here we may have the start of a second structure subdividing 3, 3, 5, an expanded flat correction. There's no rule stating a maximum limit for B waves within flats. There's a convention within Elliott wave that says when your possible B wave reaches more than twice the length of the possible A wave, it's not invalid, but the idea of a flat should then be discarded based upon a really low probability. Over the last 9 years of daily Elliott wave analysis, I've seen, I think, 1, 2 or 3 expanded flats where the B wave is a little bit longer than twice the length of the A wave. So it's very, very, very rare indeed. So I'll go with that. Discard it if it does get longer than twice the length of the A wave convention. That would, on balance of probability, be a good approach. That price point here is at 2427.77, so I'll hang on to this alternate wave count until we see a new high by any amount at any time frame above this price point. If that happens, I'll discard it, and that would reinforce the main wave count. This wave count is possible if we get this gap closed, and particularly if we get the main wave count invalidated, then I'll expect overall downward movement to continue, for minute wave C to be very, very likely to move to at least a slight new low below the end of minute A back here, so that it avoids a truncation and a very rare running flat. Running flats are very rare structures, but expanded flats, on the other hand, are very common indeed. An expanded flat subdivides 335, and it has the B wave, which is more than 1.05 the length of the A wave. The B wave makes a new price extreme beyond the start of the A wave. They are really common structures. Let's look at how this may be continuing at the hourly chart level, where B is actually this point up here, and now I'm actually considering that it's not over and it's going to move a little bit higher. All of this sideways movement doesn't look like the start of minute C down. It looks like a B wave. For this idea, A, B, C and 1, 2, 3 for an impulse subdivide in exactly the same way. And so it's impossible to distinguish between the two until you get into the fourth wave structure. For this idea, we'd be expecting a short little C wave to move probably just a little bit beyond the end of A so that it avoids a truncation, and then an imminent reversal. In other words, a false upward breakout followed by a quick reversal. Only if we see a new high above this point will I invalidate, or rather discard, this idea. A new low below 2344.51 would invalidate the main wave count and add quite a lot of confidence to this alternate, but I'll probably switch it over to a main wave count if this last gap here is closed. Let's have a look at some classic analysis first, and let's just quickly go back over the weekly chart. This looks like a symmetrical triangle, and this looks like an upward breakout, a breakaway gap and an upward breakout following this consolidation. There was volume to support that upward movement, and on balance volume gave us a bullish signal. So far all of that looks really bullish. RSI is not overbought at the weekly chart level, so there's actually quite a bit of room for price to continue on up. The only cause of concern here is ADX is above both directional lines at the weekly chart level. It's increasing, so it's telling us that there's still probably an upward trend in place, but the black ADX line being above both directional lines tells us that the trend to the upside is extreme. That's my only cause for concern. Usually when that happens, we see a pretty quick reversal at the weekly chart level. We had a bearish crossover from MACD here, and that hasn't given us in turn a new bullish signal. This is, however, a lagging indicator because it's based upon moving averages. ADX is also a lagging indicator. Most of these indicators are. If, for the next week, the positive DX line manages to move back above the black ADX line, and then this chart on the whole at the weekly chart level for the S&P will look overly bullish. Let's have a look at what's happening on the daily chart level. We've now got 2 anchor points here for resistance and 2 anchor points at least here for support, a little bit of space apart from them. So it looks like we've got a flag pattern unfolding. When flags or pennants, which are the most reliable continuation patterns, flags and pennants that is, when they're unfolding, it's nice to see a decline in volume. That offers a bit of support to the idea that price is consolidating. That's not happening here. We had good, strong volume for yesterday's upward day, and now still fairly heavy volume, but a little bit lighter for overall a downward day. The candlestick closed green, but it's got a lower high and a lower low, the definition of downward movement, and the balance of volume for this session is downward, so that's a downward day. So the strongest volume during this small consolidation is an upward day, and that suggests that an upward breakout is more likely than downward. That's a pretty simple trick. It doesn't always work, but it does work more often than not. As always, with technical analysis, we're dealing with a balance of probability, not certainty, which is why risk management is so important. There is nothing in Elliott wave nor classic analysis which is 100% certain. If there was, we'd all be multi-billionaires. There just isn't. If this is correctly labelled as a flag pattern, then we use the measured rule. We apply it from the bottom of the flagpole, I'm taking as this point here, to the top of the flagpole, and look at where the breakout is likely to be. I'm going to say that's probably at this stage about 2390 if the breakout happens tomorrow. Add that to the flagpole length to that point, and we get a target about 2459, which is just 10 points below the Elliott wave target. So we've got a bit of a range there, 2459 to about 2469. ADX is above 15 and it's increasing. At the daily chart level, ADX is telling us there's an upward trend in place and it's not extreme. As prices moved sideways overall for the last 5 days, ATR is now declining quite substantially. Now that's quite good to see. That offers a little bit of support to the idea that price is consolidating. A decline in range from day to day is pretty typical of a consolidation. On balance, volume was in a little consolidation zone here. A little upward move here is a very weak bullish signal. It's finding resistance at this trend line here. It's now down at support at this line, which was previously a little bit of resistance. It's at support today, which may possibly help to hold up price and stop it from falling. If this gap is correctly labelled a measuring gap, then we have support for price here about 2380. If the gap is closed, then it'll be relabelled an exhaustion gap, and then we would expect that we've got a high in place. That would be telling us we've probably got quite a lot more downward movement. RSI is not overbought, so there's still further room for price to rise. Stochastics is overbought, but it can remain extreme for long periods of time during a good trend for this market. Only when it's been extreme for a while and then exhibits divergence with price, preferably multiple divergence, would it be giving a strong warning that we've probably got a high in place. MACD gave a bullish crossover back here. It's still bullish. My only concern, well, apart from volume remaining fairly heavy, another concern for this consolidation is Bollinger Bands continue to widen. Now that's not normal when price is moving overall sideways. We've got an increase in volatility indicated by widening Bollinger Bands here. Normally they contract as price consolidates. And if we're expecting the S&P and gold to move in opposite directions, we really can't have that expectation because the math tells us that that's just not always the case. They can fluctuate to be moving together or moving in opposite directions. The correlation coefficient does not reliably sit below minus 0.5, so they cannot be said to have a reliable negative correlation. This is what a strong correlation looks like. The correlation coefficient should sit above or below this shaded area. If it moves through the shaded area like it does for gold in the S&P 500, then you cannot assume any correlation which exists at any point in time will persist. It's just not reliable. Let's have a look at inverted VIX. Price has made a slight new low today. Inverted VIX has made a higher high. As price moved lower today with a lower high and a lower low, volatility did not see a corresponding increase. That tells us there's some weakness within this downward movement today from price. That divergence is bullish. I will give it a very small amount of weight overall it seems to be working more often than not at the moment for inverted VIX and price. There's no divergence today between these lows, so no short-term divergence between price and the AD line. There is longer-term divergence, but I'm not going to give that any weight because it's quite weak and because it hasn't proven to be very reliable of late. I'm only going to look at short-term divergence between market breadth and price. Overall, market breadth is increasing. It's making new highs as price is overall moving upward, and so that does support somewhat the upward movement from price. I wouldn't be expecting to see a major high at this stage with no divergence for the very long term, bearish divergence, that is, between breadth and price. That's all from me with your S&P analysis, and I hope that all of our members are having a fabulous day.